Everybody wants the next big fintech winner. SoFi and Robinhood are the two names that come up over and over again. But here's the truth nobody wants to say out loud. Most investors are looking at this matchup completely backward. They think SoFi is the serious one and Robinhood is the meme stock casino. But one of these companies is quietly printing record profits and building an empire. The other, still spending like it's 2021 and hoping that bundling loans with savings accounts becomes a moat. This isn't just a fintech battle, it's a case study in execution versus narrative. One company has already crossed the line into profitability. The other is still trying to justify its valuation with growth stories and product sizzle. In the next few minutes, I'm going to show you the hard numbers, break down the actual economics behind both businesses, and tell you which one, if any, deserves a place in your portfolio. If you're tired of the hype, stay locked in, because by the end of this video, you'll know who's really winning. Growth is cheap when you're not profitable. Revenue growth sounds exciting until you realize anyone can grow revenue by setting money on fire. Let's get real. SoFi posted 33% year-over-year revenue growth to $771 million. Sounds good, right? Until you compare it to Robinhood. 50% revenue growth to $927 million in the same period. And that's not the punchline. Robinhood turned that into $336 million in net profit. SoFi, just $71 million. Look deeper and the margins tell the real story. Robinhood's net profit margin is a staggering 48.8%. SoFi is sitting at 17.4%, and that's after 6 straight quarters of scraping by to finally post a profit. This isn't even close. Robinhood is turning every new dollar of revenue into cash flow and shareholder return. SoFi is still plowing money into marketing and development to keep the engine running. You can't afford to confuse top-line flash with bottom-line fundamentals, because in the markets, profitability buys you time, leverage, and control. Growth without profits is just a burn rate with a PR team. The bottom line, Robinhood is playing chess, SoFi is still learning checkers. Growth only matters when it drops to the bottom line, and Robinhood is dominating that scoreboard. Everyone loves to brag about user numbers, but adding users is easy. Turning them into profit is what actually matters. SoFi added 800,000 new members last quarter. That brings them to 10.9 million total, up 34% from last year. On the surface, that looks like momentum, but when you dig deeper, it raises a tougher question. How much is each user actually worth? Now compare that to Robinhood. They have 25.8 million funded accounts, but here's the real kicker. They're generating $145 per user in revenue. That's what we call ARPU, average revenue per user, and it's up 39% from last year. That means their users are spending more, trading more, and subscribing to more high-margin products. One of those products is Robinhood Gold. Subscriptions are up 90% year over year, now sitting at 3.2 million. That's recurring revenue with built-in loyalty. That's a cash pipeline, not a vanity metric. SoFi, on the other hand, is still building its monetization engine. Most of its growth is in financial services, not lending. And even though they've launched a premium tier called SoFi Plus, it's too early to know if it actually moves the needle. Here's the hard truth. Robinhood is already printing money from its users. SoFi is still trying to figure out how to. The bottom line, more users don't matter if they don't pay you. Robinhood isn't just winning on scale, it's winning on value. The tokenization bombshell. This isn't a feature, this is a revolution, and most investors still don't get how big it is. Robinhood just launched tokenized US stocks for customers in the European Union. That means you can now trade over 200 US stocks, including giants like Nvidia, Apple, and Microsoft, 24 hours a day, 5 days a week. No middleman, no US brokerage required. And this isn't some gimmick. It's the start of a global platform shift. These stocks trade on the Arbitrum blockchain, a layer 2 network that cuts fees, increases speed, and enables seamless self-custody. Robinhood is already planning to launch its own Ethereum-compatible blockchain to take this even further. Now layer that with what else they're rolling out. Crypto perpetual futures for European users, staking tools for US users, and they're not stopping there. Stock tokens for private companies like OpenAI and SpaceX are on the roadmap. Most companies talk about expanding globally. Robinhood is building the infrastructure to own the rails. Traditional brokerages are sleeping. By the time they wake up, it might be too late. The bottom line, Robinhood isn't just innovating, it's leapfrogging the system. And when infrastructure changes, the power players change with it. Now let's talk about the moat myth. Is SOFI actually defensible? It sounds good on paper. One app, one bank, one solution. But the question isn't what SOFI offers. The question is what they own that no one else can replicate. Right now, the answer is not much. SOFI's pitch is simple. Be a one-stop shop for your entire financial life. Loans, investing, credit cards, insurance, and banking. And they've built a beautiful stack. But there's one problem. Every single product they offer already exists somewhere else, and often it's cheaper or better. According to independent analysts, SOFI has no economic moat. That means no lasting competitive advantage. They're spending heavily to acquire customers and upsell them more products. It's working in the short term. Product adoption is growing, but the margins are thin and the loyalty is fragile. Meanwhile, their most profitable segment is still lending. That means they're heavily exposed to consumer credit risk. One spike in delinquencies or a squeeze in funding costs, and the entire flywheel starts to wobble. Yes, they've added over $8 billion in new loan commitments this year and secured deals with big names like Blue Owl and Fortress. But deals don't make a moat. Execution does. And SOFI hasn't earned that trust yet. The bottom line, SOFI's product suite is impressive, but impressive doesn't mean defensible. Until they prove they can scale with profits and protect their turf, it's just strategy on a whiteboard. Do you want to know who's really in control? Don't look at revenue, look at the balance sheet. Let's start with Robinhood. They're sitting on $4.4 billion in cash and just expanded their share buyback program to $1.5 billion. That's not just confidence, that's dominance. When a company is buying back stock aggressively, it means they believe the market is undervaluing their future, and they have the cash to act on it. On the other side, SOFI is growing deposits rapidly, over $2.2 billion added last quarter, with total deposits now above $27 billion. That gives them cheaper funding for loans, and it's a big step forward. But here's the issue. The cost structure is still heavy. Product development and marketing alone burned through nearly $400 million last quarter. Their net interest income did rise 24% year over year, and their net interest margin is improving, up to 6.01%, but they're walking a tightrope. They need scale to drive profitability, and they're not there yet. Meanwhile, Robinhood's profitability is compounding. They're generating hundreds of millions in free cash flow and still innovating, not slowing down. That's the definition of strategic advantage. The bottom line, SOFI is growing its balance sheet. Robinhood is weaponizing theirs. One is building capacity, the other is executing with capital. So forget the hype, forget the charts. The only question that matters is this: would you buy and hold either of these companies for years? Let's start with SOFI. Here's the bull case. They're building the Amazon of personal finance. One app for everything: loans, banking, investing, credit cards, and insurance. Member growth is exploding, 10.9 million and climbing fast. Net income finally turned positive after years of red ink. Operating leverage is kicking in. Fee-based revenue is up 67% year over year. That's recurring high-margin income. If they double revenue and margins expand, earnings could 4 to 5x, and the stock could follow. And SOFI's bear case. They're trading at 90 times earnings, rich even for a high-growth fintech. They have no economic moat. Competitors can replicate every single product, and the credit risk is real. They're still heavily tied to lending. Profitability is fragile. One quarter of bad loan performance could crack the story. Now Robinhood, here's the bull case. 25.8 million users, $145 in revenue per user. That's scale with monetization. They've got 3.2 million Robinhood Gold subscribers. High margin recurring revenue is growing 90% year over year. Their quarter one earnings, $927 million in revenue, $336 million in profit. Net income margin, crazy high, 48.8%. That's absolutely elite. Tokenized stocks, EU expansion, crypto tools, they're not just competing, they're redefining the game. Now Robinhood's bear case. Regulatory risk is always lurking, especially with crypto and payment for order flow. Their PE ratio is still high at 53.55. You're paying up for execution. A big part of that growth is tied to speculative assets like crypto and options. Volatility cuts both ways. The bottom line, SOFI is still trying to prove its model. Robinhood is already printing results. If you want a long shot, SOFI might deliver someday. But if you want a business that's executing right now and has the balance sheet, product roadmap, and profitability to back it, Robinhood is the better long-term bet. The verdict. Here's the winner, and let's stop pretending this is close. Robinhood just posted a 50% revenue increase and 114% profit growth in one quarter. They're scaling faster, monetizing deeper, and expanding globally while others are still tweaking product menus. They've got $4.4 billion in cash, a $1.5 billion buyback in play, and their roadmap is 3 steps ahead of the industry. Meanwhile, SOFI is making progress. Yes, and let's be real, it's been on fire. The stock is up over 127% in the last 3 months. But there's a difference between price momentum and business momentum. One is emotion, the other is execution. SOFI is finally profitable. They're stacking members, and they've got a smart product strategy, but they're still selling the vision. HOOD is already delivering the result. I'm not down on SOFI, but I'm not going to ignore reality either. The fundamentals still don't justify the hype, yet. I'll gladly revisit my thesis after the next earnings report. If they continue this trend and flip the switch on monetization and margins, I'll be the first to say it. But for now, SOFI is not Robinhood. And I told you back in April, Robinhood was a strong buy after their earnings report. It doubled since then. That wasn't luck, that was clarity. That was knowing the difference between a story and a system that works. So here's the call. Robinhood, bullish, still buyable, profitable, scalable, forward-looking. This is first-in-class fintech. SOFI, watch list, not conviction. If they post another quarter like Q1, I'll update the position. Until then, manage your exposure. If you want to build a portfolio on strength, Robinhood is the winner. And in this market, hype runs hot, but execution runs forever. If you're not making money, it's your fault. I'm up 39% year to date. The S&P 500, just 6%. In a market this volatile, that kind of outperformance isn't normal, it's earned. And it's not just me. Take a look at this. Wreaks Havoc used my indicators and hot stock alerts and pulled in $1,050 in a single trade on Galaxy Digital. Sam, he's up $4,693 on CDNS with over $3,300 coming in a single day. This is what happens when strategy meets execution. Now here's what people miss. You don't need to be glued to your screen. Most of the wins in my community come from long-term, high-conviction stocks paired with smart risk management. But when you layer in the option trades we run, that's where it goes from steady to explosive. Inside Patreon, I break down every move, the trade setups, the risk, the math, all backed by my multi-million-dollar portfolio. No fluff, no clickbait, just real-time execution that works. And you get access for just $30 a month, less than what most people spend on coffee every week. So here's the choice. Keep reacting to the market or plug into a system that's already beating it.